Debt funds are going through a rough patch. And to take care of the underlying issues, SEBI has come out with certain norms to take care of them. What are these norms that SEBI has come out with? How will they impact the investors? All these things will be discussed in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
As I said, there are key changes that SEBI has brought out. What are these key changes?
3-4 critical things. One is that, liquid funds, which account for nearly 20% of the total mutual fund industry. It is being used as a bank account. Short-term parking, money for a few days, money for a few months, a few weeks is put there. And that has become very sizable. And liquid funds are not, really liquid, in the sense that investors use it like a liquid fund, but the underlying is not liquid. So SEBI has gone about addressing that very meaningfully. Now, 20% of all liquid fund money must be in government securities, repos, and which are actually liquid. It can be realized. So if 20% of investors, 20% of the money in a liquid fund turns up to be taken out, or investors turn up to take their money out, it can be done without any disruption, without much of a problem. Then the second thing is, provision of a staggered exit load for 7 days, which means that, it is basically setting the expectation right, that investors who invest in liquid fund should have few days, time frame, at least a week's time frame in mind. Third is that, all debt securities will be marked to market. What was happening so far is that liquid funds were very tightly regulated. They were supposed to invest in securities of only maturing within 60 days. But that apart, the valuation matrix being followed was such that even if the underlying investments are moving up and down a little bit, of course, these funds or the underlying securities or these bonds, they are not as volatile as equity or anything like that. But even nominal volatility, investors were not experiencing it because the valuation matrix made it artificially very smooth. So it looked like a nice smooth line. It always went up, and that is not the reality. So making the whole portfolio to be marked to market based on the realizable value of the underlying securities. So it will become a little more volatile. The net result of all this will be that two critical things. One is that liquid funds will become a little more volatile. Investors will look at liquid funds for a period of less than 7 days. They will have to look for other alternatives. And SEBI has enabled such alternatives. There is another category which is, overnight fund. If you want to invest for any period of less than 7 days, go there. So you will be taken care of. There won't be any exit load, and the underlying will be pretty secure. You will not get surprises. So it is actually, setting the expectation right, matching the underlying investment and investors' experience very much aligned. It makes liquid funds very safe, much safer. And the scale of this had turned out to be of a kind which could have posed a systemic risk if a lot of investors turned up to take their money out one day.
Okay, as you mentioned, the overnight funds may become popular amongst the corporate investors going forward. What about the caps of funds exposure to?
That is also a de-risking thing, that, the cap being reduced from 25 to 20%. But I think, that is something which fund managers should exercise that diligence anyway. Okay. It is not about the sectoral cap or a 5% exposure, maximum exposure to a group. That is something which most fund managers should take care of it anyway, because that is in their interest, that is in the interest of investors, and that is something which will actually not give them nasty surprise.
Okay, and even the redemption within 7 days doesn't seem to be too harsh. If it makes things better, then I think the 7 days is good enough.
The investors who come into liquid fund, if you have to see that what they are expecting substantially.
The nomenclature
that liquid and it will not go down. That is the implicit, that however you may say that mutual funds are subject to market risk, investors don't expect that they are subject to market risk and they need to experience it every time, and definitely not in liquid fund. So it is aligning with the general expectation despite the disclaimer. So liquid funds will become safer. They will yield lower return. They will be, you are unlikely to get surprised, and it will attract the right kind of investors, and it will not be vulnerable to any kind of crisis that there could be vulnerability at any point, but it's unlikely to give, if you invest for 7 days and more, liquid funds will remain reasonably attractive. And then, you have many other categories beyond this, ultra short-term bond fund, which will actually have all the traits of, what liquid fund is today.
Okay. Safer seems much better than getting...
Yes. If we have to, weigh between the two things, that greater safety and small likelihood of getting a bad surprise, I would go for greater safety.
So what will be the impact of these changes that we just discussed on the investors?
Two things. Liquid funds will become a little more volatile, which will not be, to investors' liking. But that's fine. If you invest for 7 days, you will end up having more return. If you are investing for less than 7 days, the way around is go to the overnight fund. And the other is liquid fund return will come down a little bit. Because if they are going to be forced to invest 20% in cash and cash equivalent, that part of 1/5 of the portfolio will yield lower return, marginally lower return. So these are two key impact. And the trade-off is that liquid funds become far more safe
and reliable for investors. What about the NAV of these funds? Will they in any way reflect a true picture?
Yes, because the whole portfolio will be mark to market, so they will go up and down a little bit much more. Earlier the rule was, or the understanding was, the implicit understanding or the experience has been, except on 2 occasions in the last 15 years when it went down by few paisa in a day, but except on those 2 special occasions in the last 15 years, liquid funds NAV always went up or remained where they were. It never went down. So there is a possibility that it will become little more volatile. Maybe on some occasion it will go down by a paisa or so, but that's about it.
Okay. So what about the investors getting more diversified and better quality portfolios? Would you like to elaborate on that part?
Liquid fund is a very tiny part when it comes to from an individual perspective. Liquid funds were reasonably safe. These things are not actually addressing the real problem of the debt funds in general. These are basically preemptive measure to ensure that SEBI has been worried about the state of liquid fund, the scale of liquid fund, and any problem there, which can snowball into a very big financial crisis. And increasingly, it is being used as the bank account for the companies. The wallet of the corporate sector. So making it robust, making it safer, making it, that has been the focus. Diversification, greater liquidity, more aligned, truer picture with mark to market. I think these are all steps, 9 steps being taken to ensure that, liquid funds become safer, transparent, clearer, and right kind of investors come with the right expectation in such funds.
So who should not be coming to the liquid funds now?
No, if you are investing for few days.
So liquid funds are safe and reliable?
No, this is also safe. Just that, we have to see that what kind of exit load will be clamped. Will it actually amount to 0 return for you if you just in case take your money out within 7 days? It looks like it will be, it will become, and this will benefit other investors. So in that sense, money for more than 7 days, liquid fund remains as attractive, in fact, becomes more attractive because it is safer.
Okay, I think I've got the answer that I was looking for. However, to make it very, our viewer friendly, let me just rephrase this and ask your opinion as to how do you see these changes? Is it good for an investor or is it bad for the investor? Simply put.
Great for the investor. Liquid funds are safer, and that is what you primarily expect.
All right. So it's great for you, liquid funds, and with the new norms that SEBI has come up with, it's good to invest in them because your money is going to be safe and reliable for you as an investor. We move on to the Q&A part of our program. And the first question has come from Akash. And he says, how many debt funds should I have in my portfolio? Is it wise to diversify money in different AMCs for both debt and equity?
Absolutely. In debt, it is very important. Equity, you can like one or two fund companies, equity funds of general kind, the multi-cap, the value fund, or the tax saving fund if you're just investing 1.5 lakh rupees a year, and that'll get you reasonable diversification. And if you're investing for a full market cycle, and if you like the fund or the fund manager, it can take care of it. In case of debt, it is important to diversify more than equity because things can go wrong. And but more importantly, before choosing those funds, don't get attracted to debt funds entirely based on return, because any extra return that you get from a debt fund is assuming greater risk. And assuming greater risk, and risk doesn't visit you every day. It visits you once in a while. It hits you once in a while. And so it is very important that you understand that if a fund is giving high return in the past, what it is deriving from. And if it is deriving from assuming either a credit risk or assuming a market risk of other kind or interest rate risk, then it has been right, but it is very difficult to be right all the time, unless there are funds which have assumed credit risk and they have done very well consistently. So looking at that history, understanding the reason, definitely spread your money across 2 to 3 funds. And also the difference between an equity and a debt fund investment is that equity we end up accumulating in equity, doing your SIP, investing 20,000 rupee, 50,000 rupee, 1 lakh rupee every month for a long period of time. Normally the debt investment is investing a large sum of money at one go, and going wrong there, and assuming what happened in some of the ultra short or some of the credit fund. The fund went down, the ones which had exposure to DHFL or ILFS and things like that in recent past. Some of the funds went down by 5%, 7%. And that is something which investors are not prepared for. That was not the deal. That was not the expectation. We have seen the worst situation in few funds. But that is something which can be spread, that can be mitigated by investing in 2-3 funds.
All right. Next question from Ravindra, and he says, I'm caught up with some low performing debt funds. Bonds of some funds have also experienced rating downgrades. What should be my strategy in the current situation?
Don't get out of those funds in a hurry. If you are hit by those funds, all may not be over, because typically what has happened is that some of the funds had exposure to some bonds which faulted or defaulted or did not pay the interest on time. They did not pay the interest on time, so the valuation got down, and because of the rating was downgraded. Because of the rating downgrade, the valuation took a hit. If there is a rating downgrade, a 100 rupee thing might get valued at 95 rupee or 80 rupees or whatever. Okay. But subsequently, the fund company got the interest with a delay. What was payable on a Thursday came on a Monday. But the rating has still not been revised. The day that rating gets revised, because or partially gets revised, or because a fund company's problem is that if it gets its money on time, if it gets the capital back on time, the principal on time and interest on time, investor ideally should not be out of pocket. They should not face a decline. But in this case, because they are valued every day based on a matrix, based on the rating, which has been downgraded. So even if that bond has become good or reasonable from a fund point of view, from a fund's point of view, that it is likely to get its principal back, or it has got its principal back and interest on time.
And likely to get its rating back.
Still, it will be valued low. So wait for it to resolve.
So how long?
It could take anything between 2 to 6 months.
That's a good horizon. I mean, one should wait for 2 to 6 months
to get one's principal back if you are hit by a 10%, 8% decline.
Sounds good. Dinesh says that is there any initiative taken by relevant authorities to introduce mutual fund portability like in health insurance, or at least exempt us from tax implications on switching request?
No, there is no such thing. And ideally, if I'm replacing a long-term fund with another long-term fund, there shouldn't be a tax incidence, but unfortunately it is. Not only that, we got the introduction of the direct plans were introduced. And if you had in your investment, and everybody had his investment in the regular plans before. So switching from a regular plan to direct plan is also subject to taxation because it amounts to acknowledgement of the gains.
So therefore the portability is not a possibility.
Portability is something, which is ideal, but no authority has been, nobody has initiated or mooted this idea of introducing fund portability because there is no retirement account. It amounts to creating some account, some framework so that the tax authorities can understand that this is a long-term investment or this is a pool of money which is meant for a purpose and this money remains like that.
Okay. Our next question is from Gopu and he writes, I'm a moderate risk taker and want to invest around 50,000 rupees per month with a horizon of 7 to 8 years. Which type of fund should I choose? Large, mid or small cap?
I would say that he should not invest in any of these categories. And given that he's a moderate risk taker and hopefully he's going to invest for the first time, I would like him to invest in a balanced fund and carry on with it because two things which will work very nicely for him. Next 2-3 years, he should invest in balanced fund, do his SIP, increase his 50,000 with with his rising income or his higher savings. And after 3 years, he should consider a multi-cap fund or a value fund because his idea should be to keep it simple, be able to get exposure to all parts of the market and average his investment. Okay. And being a moderate risk taker and hopefully being very likely that he's a first time investor, a balanced fund will ensure that he will not be scared out of the market.
From the look of it, it seems that he's a first time investor.
Yes.
Yeah. So therefore, that's the reason why you're suggesting balanced
fund. And anybody getting started, and balanced fund is nearly equity fund. It's 75% equity, 25% debt. Market falls, it doesn't crumble as much. So it's very comforting for anybody getting started.
Okay. And at the end of 7 to 8 years, perhaps he will have a good amount for them.
Yeah, very meaningful because, the basic threshold should be to be able to beat inflation, to be able to beat fixed income return. Fixed income return is in for a steady decline. Last week we saw the small savings rate going down by 10 basis point, 0.1%. So, and that is the roadmap. If inflation is low, interest rates will come down, and they are steadily coming down. And so, next 7-8 years, if you are able to beat inflation, and if you are able to earn more than fixed income return, one will be better off.
But how important are the fixed income funds? You said in one of your articles, it's imperative that you have some part of your investment in fixed income.
Yeah, fixed income is important. Is that, it's not either this or that. For your long-term money, you should have, because there are two reasons why everybody should have fixed income. Your emergency fund should be in fixed income. The money which you can access anytime should be in fixed income, and fixed income can come in various forms. It could be a liquid fund. It could be the money lying in your locker. It could be the money, if you have old parents and young children, very small children, then, that is your emergency fund. The money lying in your bank account, which you can access from an ATM machine. So that is all fixed income. The money which the likelihood of going down in value is not there, but it will also not yield reasonable return. Then comes, money. So that is one purpose. Money which you are likely to need in foreseeable future or your emergency fund and of that nature. That should be in fixed income. Then comes a systematic allocation. You want your money to be, all your money, if it is in equity, it will be very volatile and it can scare you. The reason why I am saying that have your balanced fund is the reason that there is an inbuilt 25% fixed income. So fixed income provides you stability. Remember 2008 when market went down by 50-60% and your mid-cap fund went down by 70% and small cap went down by 80%. Your 100 rupee becoming 20 is quite unnerving. Having your fixed income allocation provides you, it's like a shock absorber. So choose your allocation to the shock absorber. You can't really be getting that wild ride. So that you need fixed income for that. You decide whether you want 25%, whether you want 50%, because it depends on two things. One is how experienced you are in the market, and how critical is that money, and how far off you are from the goal. These three things determine that. So if your goal is 20 years away, but if you are not experienced, you'll be scared out of the market when you are faced that decline. If you don't have much time, then you should start moving to fixed income in 2-3 years time if you need all the money for consumption or for some big spending. So it depends, but fixed income is definitely needed for everybody. Long-term investment should substantially be in equity, but you can't do without fixed income.
Okay. What are the smart beta index funds? And this is being asked by Pradeep.
Smart beta index funds are modified index fund, and somebody is altering the index to make it smarter, because index funds are considered to be dumb. So by knocking something based on a principle, smart beta tends to, it is expected to beat the index by modifying the rule. So smart beta is a modified index fund which is trying to delete something or knock something from the index so that it can beat the index.
Okay. This is a question related to value research, rating the funds, and Pulkit says that how widely does a 4-star rated fund differ from a 5-star rated fund? Is there a huge difference?
Not very much. It's actually a relative thing. It's important to understand that our rating is a relative rating. So if there are too many, there could be a good fund, but if there are 12.5% of that category is filled with marginally superior performing funds on the risk adjusted scale, they will be 5-star and the next one will actually become a 4-star. Okay. The difference may not be very significant. And generally speaking, I would say that, I don't worry when a fund slips from a 5-star to a 4-star.
Okay. And if I have to choose one, should I only be looking at the 5-star funds all the time?
No. In fact, when our analysts go about looking at a fund in a certain category, our starting point is 5 and 4-star fund, and also some of the 3-star funds.
Okay, fine. Sarvanan says, I have come across many people saying that the mid-cap and small caps may experience a rally soon. Do you take the same? How I wish you tell us.
I wish I knew. But I'll tell you, the cycles of mid-cap and small caps are very long. If you look at, how often small caps do well, or, because small caps, they do horribly or they do extraordinarily well. Right. There is nothing in between. So 2018.
So either they are good or
they are outstanding, or they are actually down in the pits. Okay. There's no midway thing. And some of these small caps, even if you look at the averages, they go up by 100% in a year. And 2017 happened to be one such year. So it has not been very far off. I still feel, and I was asking this question to a very prominent fund manager, and he said that the mid cap and the small cap decline or the correction has started. It's almost like a train starting from Bombay, and it still hasn't reached, headed for Delhi, and it has reached only Ratlam. Is what he was explaining, that it may still have, but I don't know.
How do I interpret that? Is there still a long way off? Or?
Yeah, it could still be a long. That was his view. But I would say that money to be made in small and mid caps is you can make money by investing regularly in these. Money is not investment. Money in investments from investments is made not by investing at the peak. It's by investing in a phase when it's struggling, when it's not doing well. It's an act of courage. And if you keep doing that now with a 3-4 years time frame, you will get extraordinary return. But it is a courageous thing to do. It's not an easy thing to do. When you invest 1,000 rupee and next year, next month it goes down by another 5%, another 3%. But if you're investing through these lean periods, and if you have that time frame and that belief in your ability to withstand these declines, you will do well.
Okay. So there's hope there.
Oh, definitely. It's not that small caps and mid caps are to be written off forever.
Okay. Satya writes in and he says, I've been paying an annual premium of 61,000 rupees for an insurance policy with LIC. Now, it has been there for last 3 years. I plan to surrender it and go for a combination of term, plan and mutual funds. Will it be wise? Should I take any precautions?
Oh, it's always wise to split, untangle your insurance and investment. Mixing it does not get you any advantage, rather gets you disadvantage. You don't get the best of either, and superior features in terms of liquidity, valuation, or ability to take part of it. So, two precautions. One is that depending on your time frame, choose your funds well, invest regularly, and keep it simple. Multi-caps and tax saving fund, and that should do. Term plan, be liberal. We err on the side of caution. Just and with small premium you can actually get a very large cover. But don't look at term insurance as a spending, as a cost, as an expense.
It's like fill it and forget it.
It's that it's a price that you are paying for buying protection for your family, and you are protected. You have once you have the coverage. But this is the money being spent. This is not an investment, and which means that don't take too much, but don't take less. Take adequate, and that estimation is very much in your hand. How much money will be needed for your family to substitute your income for your lifetime? That is the kind of this is a decision. And typically, if everything else is in place, if you don't have a home loan EMI, I'm just talking of a simple framework of 2 kids, and if they have to be taken care of their education, if you have a house, then 8 years annual income worth of term insurance coverage is a general rule, and I don't think it is very low.
Okay. But what I don't see over here is Satya has not mentioned about medical.
Oh, that is the first thing.
He's not mentioned that here.
Yeah, 2 things. Any thoughtful financial plan should have a starting point of having your emergency fund, having your health insurance, and having your term insurance if you have financial dependence. Then comes any investment. Investment comes number 4 in your priority. But once you have taken care of these 3 things, whatever investment you start, you'll be able to stick to that plan, because by taking those steps earlier, you will not be forced to disrupt or disturb your investment plan.
That's all we have in today's Investors Hangout. Dhiren, thank you so much for answering the queries of our viewers. Till we meet next time, it's goodbye from Dhiren and me, Rajesh Lake.